On the 10-year. Let's talk about the bond market's connection to stocks. All of it in context, of course, ahead of Jackson Hole on Friday. Joining us, Aaron Gibbs is the president and chief investment officer at Gibbs Wealth Management. Aaron, thanks for being on the program with us this afternoon. You've got to look at bonds, I think, is very important. You're looking for signs of bottoming. Are they compelling right now?
It's early stages, and I'm certainly not willing to call it, but they have been able to hold a bottom since July, and even when we saw a little bit of increased fear and the markets pulling back mid-August, really last week, the bond market has held stable at sort of about that 1.2, 1.25 yield for the 10-year. So I think this is something to really watch, because right now it looks like the beginning of a bottom, which could be helpful, particularly for financials. I mean, they really are exceptionally tied to how interest rates and the yield curve, and of course absolute rates, as well as because financials are such a big part of value styles and value indices. They also tend to be indicators of how the value style is going to do. So until we see that bottom, it might be a bit of a struggle for both real value style indices as well as financials.
That's what's catching our attention today here, is they all still generally move pretty much in unison, a pretty clear story, to your point, that adds up in these relationships. I'm curious what you think has kind of anchored us a little bit. I'll risk calling it an anchor because we just saw incessant yield curve compression throughout the entire summer, and then it just kind of stopped, even with COVID kind of raging again. So why do you think that is, Aaron? What slowed down the bond bulls?
I think it's a sense that economic growth really is going to come around, and we are going to potentially see some real inflation, not just some of the transitional, or what we are hoping is transitional inflation in the past 6 months, but real economic growth and real potential inflation, and moving away from that flight of security of 10-year notes and being more willing to take on some more risk. And we see that anecdotally with the riskier stocks like Bitcoin. Some of the small caps have been doing well, and people shifting money or feeling more safe about moving into equities. When we get a better sense of we're really reopening and the economy's going to do well for an extended period of time.
How does the Fed fit into this right now, Aaron? What's kind of the framework you're using going into this week? If, let's say, whatever the market views as hawkish, let's say we get something hawkish, does that mean yields go up? Does it mean yields go down? It seems like you could pretty well argue both cases at this point.
Right. That's actually a great question, because, of course, I'm talking about how people will respond, but obviously the Fed is a very powerful control, and a lot of it is just us investors reacting to what they do, and they're reacting to economic news. So certainly a solid indication of some of the tapering through the bond purchasing programs. So, limiting the recovery and buying back some of the bonds, just taking some of the liquidity out of the market would be a real indication that bond yields potentially could, at the very least, stabilize and stop the descent. Really completely. We call it a bottom from what we saw in early January on the 10-year yields. So knowing that it might happen in October or November versus sometime in the next year would definitely be okay. It's a bottom, and rates should at least be stabilized. And then any indication they're going to raise rates, obviously, would, that kind of move, that would be very hawkish and a big surprise. We're all expecting the tapering to happen, but indications that they're going to raise rate earlier than, expected would definitely cause a move in the market.
Okay. And the conclusion, as you point out, which is if that yield stabilizer starts to move higher, then investors kind of shift over towards more that value perspective. You look for growth at a reasonable price. Just before we head to the closing bell here, give us an idea kind of where that brings you in terms of appealing investments right now. I see you look at the mega caps and say that's not exactly growth at a reasonable price anymore.
Right. So other than saying financials and financials and energies are sort of their own entities, but across the board, there's a lot of opportunities for growth over region price in a lot of different sectors. The main thing that I am trying to get to my clients is avoiding your mega caps. I think they are just extraordinarily overvalued. Even though the market is very high at its valuations right now across the board, across sectors, I think they're the ones that have the most exposure and most risk to underperforming. So they may not decline, but they might be not perform as well as the overall market. I think a lot of them have additional political risk. As well as just they're so big, it's going to be very hard for them to grow. There are exceptions, don't get me wrong. There are some really great companies within the mega caps. Microsoft is one of those. But in general, I try to find opportunities a little farther down the market cap, maybe a little under the radar, that can really have more room for capital appreciation, price appreciation, without being an extraordinarily value and need a lot of positive consumer sentiment to grow.
Okay, Aaron, thanks for the walkthrough here on the way of viewing things. Really like the pretty clear chart here showing that if we get yields to finally start moving, we got rotation on our hands. Thanks a lot, Aaron Gibbs.